So our mission today for this deep dive is to decode the complex, high-stakes ecosystem of Axon Enterprise, ticker symbol AXON. And we're looking at it exactly as it stands right now in July 2026.
And the strategy here, for you listening, is that we are going to strictly follow the source material's 10-part framework.
Right, because it forces us to evaluate the company holistically.
Exactly. We can't just look at their AI software in a vacuum without, understanding the hardware that actually feeds it. And we can't look at their massive revenue growth without scrutinizing the balance sheet that's funding it all.
It's all connected. Part 1, business analysis. Now, when the general public hears the name Axon, the immediate association is still Taser, right?
Oh yeah, always.
But the sources reveal a product ecosystem that has fundamentally evolved. It's now this dual engine model. You've got connected devices on one side and software and services on the other.
And the revenue breakdown from the Q1 2026 filings illustrates this shift perfectly.
Lay it out for us.
So Tasers, which includes the conducted energy devices, the physical cartridges, the warranties, that now makes up 28.8% of their revenue.
Okay. So still a big chunk.
Right. It's still a significant anchor.
Yeah.
It generated roughly $233 million for that quarter. But the center of gravity has totally moved.
To the software.
Exactly. Software and services is now the dominant segment. It accounts for 43.9% of total revenue.
Wow. Over 40%.
Yeah. That is over $354 million in a single quarter. And that's driven by platforms like Axon Evidence for digital evidence management, Axon Records, their real-time crime center integration called Fusus, and this rapidly expanding suite of AI tools.
It's just massive. And then to fill out the rest of the pie, Platform Solutions accounts for 13.8%. That covers the fleet and in-car video, drones, and the counter-drone systems they brought in through that drone acquisition. And finally, personal sensors sit at 13.5%, which is primarily just the body-worn camera.
Yeah, when you step back and look at that mix, it's fascinating. The hardware, the cameras, the drones, the tasers, they basically just act as data-gathering nodes in the physical world.
Just vacuuming it all up.
Exactly. The software is where the actual value extraction happens.
It reminds me of how hospital systems use electronic health records, like Epic. You buy all this physical medical equipment, the MRI machines and whatever, but the heart of the operation is the software interface that manages the patient data.
That is a perfect analogy.
Right. Once a hospital adopts it, the software dictates every single workflow. You're locked in.
The hospital software comparison is highly accurate. And just like a massive hospital system, the customer base here is characterized by near total market saturation.
Yeah, let's talk about those numbers.
So the data indicates that Axon has established relationships with approximately 17,000 out of the 18,000 U.S. law enforcement agencies.
That is just absurd.
It is. That's a level of market penetration that most enterprise software companies can literally only theorize about.
They aren't even competing for market share anymore. They effectively are the market.
Yep. And geographically, 80% of that revenue is generated domestically, right here in the United States.
But there's a really critical data point from Q1 2026 showing international revenue accelerating, right?
Very much so.
Oh.
It's currently sitting at 20% of their total revenue, which is up from 12% just a year prior.
That's a huge jump. We're definitely going to dig into the mechanics of that international growth later. But the true engine of this business model, the metric that absolutely commands Wall Street's attention, is the recurring revenue.
Right, the ARR.
Exactly. We are looking at $1.5 billion in annual recurring revenue, growing at 35% year over year.
What's fascinating here is how that growth is actually sustained internally. They report a net revenue retention, or NRR, of 125%.
Okay, let's really break down the mechanics of that 125% figure for everyone, because it is the absolute bedrock of their valuation.
Sure. So if we take a hypothetical mid-sized police department, right?
Correct.
Say they signed a contract with Axon for $1 million in 2025.
Okay.
An NRR of 125% indicates that in 2026, without Axon having to go out and acquire a single new agency, that exact same department is now spending $1.25 million.
Just by expanding their current usage.
Exactly. The structural attrition rate, the amount of revenue lost at customers actually leaving the platform, is functionally non-existent.
Yeah, the company's filings literally describe it as de minimis.
Right. Customers are not migrating away. They are systematically expanding their footprint within the ecosystem.
Like what specifically?
Well, they're purchasing additional cloud storage as video resolution increases. They are outfitting administrative staff with software licenses. And they're adding these modular features like interview room recording or AI transcription.
It creates this completely closed loop of continuous monetization. I mean, once an agency buys the initial body cameras, it just makes operational sense to buy the dash cams and the tasers that automatically trigger those cameras. And all of it feeds right back into the same cloud storage system.
Exactly, as an ecosystem lock-in.
But I do have a fundamental question about this whole trajectory. I'm going to push back a bit.
Go for it.
If they already hold contracts with 17,000 out of 18,000 domestic agencies, the primary U.S. market is fully saturated.
Right.
So isn't their market completely tapped out? The logical assumption is that growth must inevitably plateau once everyone has the hardware.
Well, that assumption makes total sense if you view them purely as a hardware vendor.
Okay.
But the terminal value of Axon relies on the premise that hardware saturation is merely the prerequisite for the software monetization.
Ah, so the hardware is just the Trojan horse.
Basically, getting the devices onto the duty belt was phase 1. Phase 2 is leveraging all the data generated by those devices to create an ecosystem so deeply integrated into the agency's daily operations that leaving becomes literally impossible.
Which naturally leads us to evaluate the actual defenses they've built around that ecosystem. Let's move to the next section. Part 2, moat analysis.
Let's do it.
So in the context of business strategy, for you listening, a moat is simply the structural advantage that protects a company's long-term profitability from competitors. And the equity analysis in our source stack rates Axon's moat as wide and widening.
That's a very strong rating.
Yeah. It implies the competitive advantage is resilient enough to last decades, and that the barriers to entry are actively growing stronger.
Right. And the foundation of this specific moat is built heavily on switching costs.
Let's talk about that.
Law enforcement agencies typically sign these massive 5 to 10 year bundled contracts. They're often referred to as officer safety plans. Yeah. And just the sheer duration of the contract introduces a lot of initial friction. But the true switching cost lies in the operational reality of managing digital evidence.
Let's really explore that operational reality, because we aren't talking about migrating some standard corporate database or moving from Google Drive to Dropbox.
No, not at all.
When a police department uses Axon evidence, they are constantly uploading petabytes of body cam footage. And this footage is subject to rigorous legal standards regarding the chain of custody.
Exactly.
If a police chief decides, hey, I want to transition to a competitor's cheaper cloud storage, they can't just drag and drop those files. It's like trying to change the foundation of a house while you're still living in it. It's just too costly and risky.
The legal complexities are immense. Think about it. Every single video file has associated metadata. It has cryptographic hashes ensuring the footage hasn't been altered.
Right.
And it has access logs detailing exactly which officer or which attorney viewed the file and exactly when.
And this data is actively being used in ongoing investigations and court cases right at that moment.
Exactly. If an agency attempts a migration and even a single file's metadata is corrupted or a hash doesn't match,
then what happens?
That piece of evidence can be completely thrown out of court. The defense attorney will immediately argue the chain of custody was broken.
Wow. So the technical risk of that migration is just staggering.
Yeah.
An agency would literally have to maintain both the legacy Axon system and the new competitor system simultaneously during the transition.
Yes. They'd have to retrain their entire administrative staff and incur these massive IT consulting fees just to ensure legal compliance.
So the financial and operational cost of executing that switch would almost certainly eclipse whatever cost savings the competitor was offering in the first place.
Precisely. Consequently, agencies simply renew their Axon contracts. It's the path of least resistance.
So that dynamic completely locks the customer in. But a moat becomes widening when it benefits from network effects. And the sources categorize Axon's network effects as narrow, but widening.
Yeah, and the network effect here isn't about like consumer virality, like a social media app. It is about interagency collaboration.
Let's contextualize how a network effect actually operates between different police departments.
The prime example is their real-time crime center software, FUSIS.
Okay, how does that work?
Imagine a scenario where a suspect flees a jurisdiction. They move from a city police department's territory into the surrounding county sheriff's zone.
Okay, pretty common scenario.
Right. Now, if both of those agencies are operating on the Axon network, the city police can instantly share live drone feeds, traffic camera data, suspect profiles directly to the sheriff's dispatch screens.
Just boom, it's there.
The integration is totally seamless. However, if that county sheriff uses a disjointed legacy on-premise server from a completely different vendor, that real-time data sharing just hits a brick wall.
Right, so the sheer utility of that interoperability creates a really powerful gravitational pull. I mean, if the state police, the neighboring city, and the county sheriff are all using Axon, your department is heavily incentivized to just adopt the same standard.
Exactly. The network becomes marginally more valuable to every participant with each new agency that joins.
What about the brand value? Because in the public sector, procurement is ultimately governed by tax dollars, meaning price is always a huge factor.
True. And the sources do acknowledge intangible assets as a component of the moat. The Taser brand is an iconic, genericized trademark, much like Kleenex or Xerox.
Right. People just say taser him, not use the conducted energy device on him.
Exactly. Furthermore, Axon holds a really robust portfolio of hardware and software patents. But the analysis introduces a really critical caveat here. Axon does not possess a low-cost production advantage.
Interesting. Why is that?
They manufacture significant portions of their hardware in Scottsdale, Arizona. They do not have a structural ability to undercut competitors on the baseline manufacturing cost of a camera or a stun gun.
Oh, well.
In fact, their gross margins are currently facing downward pressure due to global tariffs on electronic components.
Okay, so they're completely dependent on the ecosystem lock-in to maintain their pricing power because they certainly aren't winning on baseline manufacturing costs.
Exactly.
This actually invites the question of counterpositioning. For you listening, in business theory, counterpositioning occurs when a challenger introduces a superior alternative business model that the incumbent cannot adopt without cannibalizing its own core business.
Like digital photography destroying Kodak.
Exactly. Or streaming destroying Blockbuster. So I have to ask, is anyone successfully utilizing counterpositioning against Axon right now? Are there cheaper, better alternatives?
Based on the competitive landscape detailed in the sources, true counterpositioning is completely absent.
Really? No one?
No one. The most formidable incumbent competitor is Motorola Solutions, and Motorola is aggressively attempting to just replicate Axon's model. They're developing their own integrated video-as-a-service software bundle.
Oh, so they're just copying the playbook.
Exactly. Motorola matching the strategy doesn't inherently undermine Motorola's legacy radio business, nor does it represent a fundamentally new paradigm. It is simply a traditional, resource-heavy war of attrition to try and build the superior bundle.
Got it. Okay, so if the moat is wide, but the domestic market is completely saturated with hardware, we really have to isolate the mechanics of their future expansion. Because 35% ARR growth requires massive new capital inflows.
It definitely does.
Which brings us to part 3, long-term growth drivers analysis. The source material divides this into 2 distinct vectors. You've got acquiring new customers in unpenetrated markets and extracting deeper wallet share from the existing base.
Let's start with market expansion, specifically through mergers and acquisitions, or M&A. Axon is deploying capital aggressively to acquire adjacent technologies, and then they just plug them straight into their massive distribution network.
Yeah, the sources highlight the staggering numbers here. The acquisition of INVESTeaDI, highlighted in the Q1 2026 data, is a prime example of this strategy.
It really is.
But the counter-drone market is sort of fascinating. Why on earth is a body camera company buying a counter-drone defense system?
Well, as commercial and consumer drones become ubiquitous, they represent a significant emerging threat vector in public safety.
Like what kind of threats?
Whether it is unauthorized drones entering restricted airspace around airports, or, being used for illegal surveillance over massive stadiums, or even dropping contraband into correctional facilities. Law enforcement urgently needs a mechanism to detect, track, and neutralize them.
Oh, wow. I hadn't even thought about dropping stuff into prisons.
Yeah, it's a huge issue. So Axon acquired INVESTeaDI's technology and immediately leveraged its 17,000 agency Rolodex to sell it.
And the financial impact is just immediate. The Q1 2026 data shows INVESTeaDI's revenue increasing 300% year over year post-acquisition. 300%.
Incredible, right? And they're executing the exact same playbook with a dispatch product called Axon 911, which was built from the acquisitions of companies named Carbine and Prepared.
And how is that doing?
The bookings from those specific 911 integrations have already surpassed 1.5 times the initial purchase price of the companies.
So it is a highly, highly efficient model of capital allocation. You buy a niche technology, you push it through an unrivaled sales pipeline, and you rapidly scale the revenue.
That's the formula. Beyond M&A, the second lever for acquiring new customers is international and enterprise expansion.
Right. We noted earlier that international went from 12% to 20% of revenue in a single year.
Yeah. And the structural dynamic driving this, according to the analysis, is a phenomenon of leapfrogging.
This concept of leapfrogging provides such great context. We saw this in the telecom sector, where developing nations entirely bypassed the immense infrastructure cost of laying copper landlines, and they just jumped straight to building cellular towers.
Exactly.
But how does this apply to police technology?
Well, international agencies, or, smaller nations that have historically operated with underfunded, paper-based, or highly fragmented legacy IT systems, they are not going through the intermediate step of building local server farms to store digital evidence.
Right. The capital expenditure required to build and secure an on-premise data center is just prohibitive.
Exactly. Instead, they are leapfrogging that entire era of IT infrastructure and adopting Axon's cloud-native ecosystem from day one.
Just jumping straight into the cloud.
Yes. This clean slate environment dramatically shortens the sales cycle and accelerates deployment.
Concurrently, they are also expanding into the private enterprise sector. We're talking commercial security, healthcare facilities, large retail chains.
Yeah, the sources cite a $40 million contract within the telecom industry, specifically for the Fusus real-time integration software.
Wow. So the addressable market is no longer strictly limited to municipal police departments.
Not at all. But that covers the expansion of the customer base. However, the internal growth engine, the mechanism driving that 125% net revenue retention, is heavily dependent on the introduction of new products.
Here's where it gets really interesting, the AI push. Axon is rolling out a premium suite known as the AI Era Plan.
This is the big one.
Yeah. The flagship feature is a tool called Draft One, which utilizes AI to basically automatically generate the narrative text of police reports by transcribing and analyzing the audio from the officer's body camera.
And the market reception is just extraordinary. The Q1 2026 data reveals that bookings for the AI Era Plan are up 140% year over year.
140%.
Yes. Furthermore, total revenue from AI-specific products has surged 700%.
That is insane.
Though, it is important to note that growth is accelerating from a relatively small initial baseline, to be fair.
Sure, but still, the rapid adoption makes perfect sense when you consider the pain point it actually solves. I mean, drafting reports is universally cited as the absolute most administratively burdensome aspect of policing.
Oh, yeah. Cops hate the paperwork.
Right. If a software add-on can definitively return, say, 2 hours of patrol time to an officer every single shift by automating paperwork, a police chief will absolutely justify that budget allocation.
When we synthesize all these growth drivers, a really clear dual threat strategy emerges. Externally, Axon is capturing massive new accounts in international and enterprise markets by leading with their comprehensive ecosystem.
And internally?
Internally, they are aggressively expanding wallet share. They're upselling these high-margin productivity tools, like AI transcription, to their existing captive domestic base.
On paper, it sounds fantastic. It is a flawless growth engine. But in the physical world, growing this fast, running an engine at maximum RPM, usually breaks something under the hood.
It generates intense heat and stress, that's for sure.
Right. Rapid expansion, heavy M&A activity, and global hardware manufacturing usually create some friction in the financial mechanics. So let's look at the mechanical metrics.
Good idea.
Which brings us to part 4, business phase key metrics. Our source material employs a specific mechanical scorecard to evaluate the company's financial posture.
Right. And based on their operating margins, Axon is categorized as being in phase 3, which the sources label as self-funding growth.
What exactly does phase 3 mean for them?
The defining characteristic of a phase 3 company is that it generates enough internal cash flow to sustain its own operations and expansion, which basically eliminates the constant need to issue massive secondary stock offerings just to keep the lights on. However, the company is still actively choosing to prioritize top-line revenue growth and market share acquisition over maximizing bottom-line profitability.
Got it. So the scorecard evaluates 5 fundamental metrics, grading them as green, yellow, or red. Given the 35% ARR growth and the impenetrable moat we just discussed, you would expect a pristine scorecard, right?
You would think so. But the overall health rating provided by the analysis is surprisingly weak.
Wait, really? Weak?
Yeah. Only one of the 5 metrics achieves a green rating.
Wow. Okay, this discrepancy between the narrative and the numbers is exactly why deep financial analysis is required. We have to separate top-line momentum from bottom-line efficiency. Let's begin with the single green metric, the good, revenue.
The top-line momentum is undeniably green. The 3-year compound annual growth rate, or CAGR for the revenue, stands at a massive 32.7%.
Give us the absolute figures on that.
Sure. Revenue scaled from $1.19 billion in fiscal year 2022 to $2.78 billion in fiscal year 2025.
That's a huge jump.
It is. They have executed 9 consecutive quarters where revenue growth exceeded 30%. For an enterprise that still has to manage physical supply chains and manufacturing, that consistency is just remarkable.
Okay, so the revenue engine is functioning perfectly, but the structural weaknesses, the margins and the cash flow, those are the yellow and red flags.
Right. The first point of concern is the adjusted gross margin, which is actively declining.
Down to what?
It declined from 63.6% down to 61.6% year over year in the Q1 2026 period.
Okay, what specifically is eroding that margin?
2 primary factors. First, the geopolitical landscape. Global tariffs are actively increasing the raw material and component costs required to manufacture their hardware.
Makes sense. And the second?
A shift in product mix. They're currently selling a higher volume of hardware within the platform solutions segment, like the drones and in-car systems, which inherently carry lower margins than their pure cloud software. The critical takeaway from this margin compression is that Axon is currently absorbing these increased manufacturing costs rather than passing them seamlessly on to their government customers.
Probably to protect their market share.
Exactly.
But this pressure cascades down to the operating margin, right? Which is sitting at a razor-thin 3.6% for Q1 2026.
Yeah, that earns a yellow flag. While maintaining any profitability is better than the operating losses they reported in FY25, a 3.6% margin means the business is running incredibly close to the wire.
There is almost zero buffer for an execution error or an unexpected spike in supply chain costs.
None. Consequently, the free cash flow is highly volatile, triggering another yellow flag. In fiscal year 2025, free cash flow plummeted 77% year over year, landing at just $75 million.
$75 million on nearly $3 billion in revenue. That's rough.
Yeah. The company has provided guidance projecting a massive rebound to $450 million for FY26, but the present reality is that cash conversion is remarkably weak for an entity of this size.
Okay, so that's the bad. Then we arrive at the ugly. The red flag on the scorecard. Shareholder dilution.
This is a big one.
The total number of outstanding shares is expanding at approximately 4% annually. And Axon's own internal stated target is to restrict dilution to under 1%, or at an absolute maximum, 2.5%.
Right. They are consistently breaching their own ceiling, diluting existing shareholders.
The mechanics of this dilution are tied to these complex financial instruments, specifically the conversion of convertible notes and warrants. Let's clearly define how convertible debt dilutes the retail investor, because it's a really vital concept.
Definitely. So when a company issues a convertible note, they are essentially taking out a loan from institutional investors.
Okay, standard loan.
Right. But instead of just paying back the principal with interest, the agreement includes a mechanism where if the company's stock price reaches a certain threshold, the debt can be converted to brand new shares of stock.
And warrants operate similarly, right?
Exactly. Warrants give the holder the right to purchase new stock at a predetermined price. So when the stock performs really well, as Axon's has over the last few years, these instruments are exercised.
And what happens then?
The company literally prints millions of new shares out of thin air to hand to these note holders.
And when you increase the total number of shares in existence, every existing share becomes slightly less valuable. The pie gets larger, but your specific slice gets thinner.
That's dilution in a nutshell.
Okay, I have to push back here. Wait, how can a company with 125% net revenue retention, a virtual monopoly on domestic agencies, and over 30% revenue growth have a structurally weak scorecard? It feels contradictory.
It does feel that way.
Yeah.
But the reconciliation requires understanding executive intent.
Okay, explain that.
The scorecard is weak because Axon's leadership is willfully sacrificing short-term margin and current cash flow to finance a massive land grab.
Oh.
They are operating much like early Amazon. They are suppressing bottom-line profits to fund rapid M&A, to push into European markets, and to heavily subsidize R&D for AI development.
So it's deliberate.
Completely deliberate. They believe the lifetime value of capturing these new markets completely eclipses the value of hoarding cash today. Axon is sacrificing margin and cash right now to fund rapid expansion.
It is an aggressive, calculated gamble on the future. But running a massive enterprise on a 3.6% operating margin while leaning on debt introduces severe vulnerabilities. Those compressing margins and macro headwinds naturally lead us to the specific risks threatening the business.
Which brings us to the next part.
Exactly. Part 5, risk analysis. Now, even a wide moat cannot insulate a company from macroeconomic gravity. The source material evaluates the overall risk profile of Axon as medium.
Right. And that medium rating is heavily supported by one highly favorable metric, customer concentration.
That's a green light, right?
A definitive green light. Because Axon distributes its services across 17,000 distinct agencies, no single customer accounts for more than 10% of total revenue.
So if a major metropolitan department unexpectedly severed their contract?
I mean, it would generate negative media attention, obviously, but it would not pose an existential threat to Axon's solvency. The revenue base is incredibly decentralized.
Okay, that's the good news. However, the risk assessment identifies a prominent red flag categorized as outside forces. And the most potent outside force is the absolute reliance on municipal and federal government budgets.
This is the red risk. Axon's entire revenue pipeline is tethered to the health of the tax base.
Right. If the broader economy hits a severe recession, consumer spending drops, property values stagnate, and municipal tax revenues just plummet.
And when city budgets contract, procurement inevitably slows down.
Yeah, I mean, while public safety is typically shielded from the deepest cuts, an economic downturn will absolutely lengthen the sales cycle. Agencies will delay the hardware refresh cycle for their tasers, or they'll postpone the adoption of those premium AI software tiers.
Exactly. The macroeconomic environment directly dictates their growth velocity. Furthermore, the global tariffs we discussed earlier remain a persistent outside force, actively compressing their gross margins.
Now, there is one additional external risk we must outline here, and I want to be very clear. We are strictly adhering to the neutral disclosures provided in the financial analysis. We are purely looking at what the financial sources say here. We aren't taking any political sides, just noting that government contracts bring inherent regulatory spotlight risk.
Right. Providing surveillance and public safety technology to law enforcement inherently attracts intense political and regulatory scrutiny from all sides.
The sources reference a 2026 media report concerning a federal official's stock transactions occurring prior to a contract solicitation from IC Immigration and Customs Enforcement.
And the underlying takeaway here isn't really about that specific incident. It's rather about the permanent environmental reality Axon operates within.
Exactly. When a company's end users are government agencies engaged in public safety, evidence collection, and surveillance, every major contract, product launch, or policy change is subject to rigorous public debate.
And this heightened scrutiny functions as a permanent friction cost. It can delay large-scale deployments while city councils debate privacy implications. It can trigger expensive regulatory audits.
Or it can force the company to continuously re-engineer its products to comply with shifting local legislation.
Exactly. Finally, under the risk umbrella, the analysis evaluates the competitive landscape as a yellow risk, highlighting the emergence of a duopoly between Axon and Motorola.
Right, the two-horse race.
Yeah. Motorola possesses immense structural leverage because they historically dominate the police radio market.
Oh, right. Every cop has a Motorola radio.
Exactly. And they are utilizing that entrenched presence to aggressively bundle their own video and software solutions, attempting to crowd Axon out of the control room.
And simultaneously, while Axon battles Motorola for the comprehensive ecosystem, you've got these agile point solution startups just nipping at the edges, right?
Yeah. Companies like Flock Safety, which specializes in automated license plate readers, or Verkada, focusing on enterprise security cameras. They aren't trying to replace Axon's entire software suite.
Right.
Instead, they approach a municipality and offer to handle specific intersections or buildings at a fraction of the cost of an Axon bundle.
They just force Axon into a perpetual state of having to justify that premium price tag of their comprehensive ecosystem.
Exactly. Defending the core ecosystem against Motorola, while simultaneously acquiring adjacent startups like Dedrone to fend off agile competitors, it requires tremendous liquidity. Wars of attrition are capital intensive.
So, if fighting a duopoly and making massive acquisitions takes a lot of capital, how healthy is the bank account? Let's investigate exactly how they are funding this multi-front expansion.
Let's look at the balance sheet.
Part 6, Balance Sheet Red Flag Checker. The source analysis conducts a forensic evaluation of the latest Q1 2026 10Q filing, specifically screening for 5 accounting red flags.
And the results show that 2 out of the 5 red flags are actively present.
Let's start with the good news, the 3 metrics that pass the screen.
Sure. First, goodwill represents only 26.8% of their total assets.
Let's briefly define goodwill for everyone. When Axon acquires a company like Dedrone, they often pay more than the raw physical value of Dedrone's assets.
Right.
That premium, which accounts for brand value, intellectual property, future potential, is recorded on the balance sheet as goodwill. If a balance sheet is comprised of more than 50% goodwill, it suggests the company is vastly overpaying for acquisitions and inflating its asset base with intangible, unproven value.
Precisely. So at 26.8%, Axon's goodwill is well within a healthy range. It indicates disciplined acquisition pricing. No flag there.
What's the second green flag?
Retained earnings. They sit at a positive $1.1 billion. This demonstrates a historical capacity to actually generate and accumulate legitimate profit over the life cycle of the business.
Always good to see. And the third?
The third green flag is the absence of preferred stock. Preferred stockholders stand in front of regular retail investors in the event of liquidation, and they often receive guaranteed dividends. The lack of preferred stock ensures common shareholders aren't structurally disadvantaged.
Okay, so the foundation appears solid. But we've got 2 active red flags that require deep scrutiny.
We do.
The first red flag is the disproportionate growth of accounts receivable relative to revenue.
Right. First, accounts receivable grew 42% in FY25, outpacing revenue growth, which is only 33.5%.
Accounts receivable, which is capital owed to Axon by customers that has not yet been collected, expanded way faster than recognized revenue. Why is that bad?
Well, when accounts receivable outpaces top-line sales growth, it demands investigation, because it can indicate a practice known as channel stuffing.
Let's dissect how channel stuffing actually occurs in enterprise sales.
Okay, imagine an Axon sales representative approaching the end of the 4th quarter. They are desperate to hit their annual quota.
Naturally.
So to close a massive deal with a state police department, they might offer extremely generous credit terms. They agree to sign a contract and ship the hardware in December, allowing Axon to recognize the revenue on their year-end income statement.
Right, making the numbers look great.
Exactly. But they tell the department they don't actually have to pay the invoice until the following July.
Wow. So the top-line revenue looks fantastic for Wall Street, but the actual cash hasn't entered the bank account at all.
Exactly. Now, the analysis notes that this accounts receivable imbalance did improve sequentially in Q1 2026, which suggests it might just be a timing issue related to the lengthy procurement cycles of government contracts rather than systemic channel stuffing.
Fair enough. But cash flow is paramount, and a growing pile of IOUs is definitely a valid red flag.
It is. And this focus on cash leads directly to the second, more substantial red flag, the fundamental restructuring of the balance sheet. Axon has officially flipped to a net debt position.
Right. Historically, the company operated with a conservative balance sheet. They held more cash than debt.
But that paradigm shifted dramatically in March 2025 when they issued $1.75 billion in fixed-rate senior notes.
And the current snapshot, as of Q1 2026, shows that $1.75 billion in fixed-rate debt, sitting against only $737 million in liquid cash and short-term investments. They essentially owe $1 billion more than they have on hand.
Yes, they do.
Let's put this into a relatable context. This is the corporate equivalent of taking out a massive second mortgage on your home, right? Putting massive home renovations on a fixed-rate loan to construct a new income-producing wing, betting that the future rental income will easily cover the fixed loan payments.
That's a great way to look at it. Axon levered up to purchase companies like Dedrone and Carbine.
So should you be worried that they owe $1 billion more than they have in the bank?
Look, alarm might be an overstatement, but it mandates a recalibration of risk.
Yeah.
The mitigating factors are that the debt carries a fixed interest rate, shielding them from the volatility of central bank rate hikes.
Right.
And the principal maturities aren't scheduled until 2030 and 2033. There is no immediate liquidity crisis, especially considering they still have untapped revolver capacity, nearly $300 million in a revolving credit facility.
So they have breathing room.
Yes. But it proves they are heavily leveraging to fund M&A. And combining a 3.6% operating margin with $1 billion net debt position means the margin for error is virtually zero. They are entirely reliant on the acquired companies generating sufficient future cash flow to service that debt.
So we have a highly complex picture here. A high-growth, leveraged company with margin pressure, locked-in customers, and a dominant market position. How on earth does the market put a price tag on that?
It's all about extreme optimism regarding the future software transition.
Let's examine the math behind that optimism. Part 7, Company Valuation Metrics Analysis.
Let's dive in.
For most retail investors, the default metric for evaluating a stock's price is the trailing 12-month price-to-earnings ratio, or PE. It simply measures how many dollars you have to pay for $1 of the company's historical profit. An average stable company in the S&P 500 might trade at a PE of 15 or 20.
Right, and according to the sources, Axon's current trailing 12-month PE ratio is sitting above 200x.
200 times earnings. I mean, traditional value investors look at a 200 PE and immediately dismiss the stock as wildly overvalued. It's almost laughable.
Which is exactly why the analysis instructs us to ignore PE and PFCF at this stage. When evaluating a Phase 3 company, the GAAP earnings, the official accounting profit, are just far too noisy.
Because they're intentionally suppressing them.
Right, exactly. Because they are intentionally suppressing earnings to fund growth, the denominator in that PE equation is artificially small. They were absorbing massive debt inducement charges from the $1.75 billion note issuance, they were writing off acquisition costs, and they were funneling cash into R&D.
So the GAAP earnings simply do not reflect the underlying cash-generating capacity of the recurring revenue engine.
Right, the PE ratio is statistically broken. And the analysis also suggests discarding the price-to-free cash flow multiple for similar reasons. FCF is currently similarly too volatile to anchor evaluations, as they strategically build up hardware inventory to hedge against those supply chain tariffs.
So if earnings and cash flow multiples are completely useless here, what is the metric that matters?
We look at price to sales, or PS. This metric bypasses the volatile profitability margins entirely and compares the total market capitalization of the business directly against its top-line revenue over the trailing 12 months.
Okay, so what is it?
Based on a market capitalization of approximately $45.6 billion and a trailing revenue of roughly $2.98 billion, Axon is trading at a price-to-sales multiple of roughly 15x.
15x.
If we connect this to the bigger picture, a 15x revenue multiple is an exceptionally rich valuation. It demands near-perfect execution. That is the multiple you assign to an elite, pure-play software company with 80% gross margins, not an enterprise that still physically manufactures and ships hardware, cameras, and stun guns.
So the market is valuing Axon not for what it is today, but for what it assumes it will become tomorrow. The market sees that software and services currently represents 43.9% of revenue, and they're aggressively pricing in the assumption that it will eventually become 70 or 80% of the business.
Exactly. A 15x multiple is priced for absolute perfection. Investors are paying a premium today on the conviction that the 30% revenue growth and the 125% net revenue retention will remain structurally intact for years to come.
But the inherent danger is that if that growth decelerates at all, if top-line expansion drops from 33% down to 18%, the market will violently re-rate the stock, right? Crushing that 15x multiple.
Yes. And because they are priced for perfection and the valuation offers no safety net, the sources emphasize monitoring a secondary metric, price to gross profit.
Why that one?
It is key to watch to ensure the margins don't continue to bleed from tariffs. If top-line revenue continues to expand, but gross margins deteriorate because Axon can't offset the tariffs, the actual economic value being generated per dollar of sales is shrinking.
Got it. The gross profit trend is the canary in the coal mine. And because they are priced for perfection, the stock chart over the last year has been an absolute roller coaster.
It really has.
Let's trace that volatility. Part 8, price and sentiment analysis.
Okay.
The 12-month round trip detailed in the sources is a masterclass in market psychology. In August of 2025, Wall Street was engulfed in AI euphoria, right? And Axon's software growth narrative pushed the stock to an all-time high of roughly $886 per share.
At $886, the multiples were just completely disconnected from the mechanical reality of the balance sheet.
And then came the brutal reality check. Over the following 2 quarters, investors began to scrutinize the 200x PE. They digested the implications of the $1.75 billion in new debt, and they reacted to a broader macroeconomic contraction in AI valuations.
Those were a perfect storm.
The result was a brutal 57% peak-to-trough correction. The stock hit a low of $339 in April 2026. More than half of the company's market capitalization evaporated in 8 months.
This is the mechanical reality of multiple compression. The underlying business didn't fail. Revenue was still growing at 30%, but the market sentiment shifted, and investors simply refused to pay the previous premium for that growth.
But then the narrative flipped again. A strong May earnings beat, delivering 34% revenue growth and raising their full-year FY26 guidance to 30 to 32%, sparked a massive recovery.
Right, back to the mid-500s by July.
So to understand where the price goes from here, we have to isolate the core arguments of the bull versus bear case. What are the bulls saying?
The bulls say the 125% NRR and the 140% year-over-year growth in AI era bookings prove the moat is impenetrable and monetization is just beginning. They view the international and enterprise markets as vast greenfields.
And what do the bears say? Why did it break down to $339?
The bears say the 200x plus PE, the rising net debt, and the margin compression leave literally zero room for an execution misstep. They argue that a 15x price-to-sales multiple is mathematically unjustifiable given those factors.
So if you are the listener looking at this chart, is it a buying opportunity or a falling knife?
Well, you have to balance the Wall Street consensus, which is mostly buys, with targets around $670 to $750 against the reality of that incredibly rich valuation.
Right. And one of the main reasons bulls are willing to pay that premium is Axon's positioning in the AI revolution.
Exactly.
Let's test how real that is. Let's test the defenses. Part 9 AI disruption resistance analysis, or as the industry colloquially refers to it, the sauce apocalypse.
Yeah, that's the fear. As generative AI models become exponentially cheaper, many traditional software as service companies face the threat of being instantly replaced by a faster, cheaper AI startup.
But the source material evaluates Axon's robustness against AI disruption through 4 distinct lenses and ultimately grades them as overall robust.
Achieving a robust rating against AI disruption is rare. Axon benefits from deep structural defenses. Let's run through the 4 lenses.
Okay, lens number 1, liability. This is rated green.
Right. The concept of an AI hallucinating is a nuisance if it's writing a marketing email. But AI errors in police reports have massive legal stakes. It can compromise a prosecution or trigger civil rights litigation.
So AI can't operate autonomously here.
No. Axon forces a human-in-the-loop review process, preventing careless hallucinations. An agile startup can't easily penetrate this because they lack the institutional trust and legal guardrails Axon provides.
Lens number 2, physical world, also green.
You can't replace a physical taser or drone with ChatGPT. As long as public safety requires physical interaction, agencies need hardware. The physical hardware anchors them.
Lens number 3, network and data, green again.
To train AI, you need data. Axon has petabytes of proprietary non-public video. AI agents can't easily scrape or replicate this data moat.
So what does this all mean? It sounds invincible.
Well, there is the 4th lens,
the
critical failure point, the business model. And this one is red.
This is the fatal flaw. Axon sells AI like Draft One on a per officer or seat basis. It's roughly $50 per officer per month.
Right. They use a legacy software pricing model. But the marginal cost of computing power for these models is plummeting. What happens if a cheap point solution competitor offers usage-based pricing or a flat fee?
Like Blockbuster versus Netflix. Netflix offered a flat subscription because the digital delivery cost was near zero.
Exactly. If a competitor offers a tool that's 90% as effective but uses a flat fee, agencies might start decoupling the AI from the hardware bundle. They might keep the cameras, but use a cheaper API for AI.
Which collapses Axon's high-margin software growth thesis. The seat-based model is highly susceptible to cost disruption. So, with all this potential and all this risk, what are the insiders and the biggest investors actually doing with their money? Let's follow the cash.
Good call.
Part 10, insiders, super investor, and company buyback activities. The sources track the buying and selling patterns, and the signal is slightly bearish. Insider selling.
Right. Insiders have been net sellers to the tune of approximately $46 million over the trailing 12 months.
And the CEO, Rick Smith, sold tens of millions of dollars of stock in mid-2026. When a retail investor sees that, the instinct is to assume he's abandoning ship.
But we need context here. This is mostly through pre-scheduled 10b5-1 plans.
Right, which are automated, blind schedules set up months in advance to avoid insider trading accusations, so it's not a panic sell.
Exactly. But the complete lack of insider buying is a mildly cautionary signal. No executive is deploying personal capital to buy at these valuations.
What about the super investors and buybacks?
There are no massive value guru super investors holding this. It's mostly index and growth funds like BlackRock, Vanguard, Bailey Gifford.
And buybacks are practically non-existent, right?
Yeah, only 33.8 million since 2016.
So the dilution remains unchecked.
Synthesizing this, the company is purely in reinvestment mode. They are using capital for M&A, not to reward shareholders with dividends or buybacks.
Wow. Okay, let's recap the massive journey we've just taken through the Axon ecosystem. We've seen a wildly successful recurring revenue engine anchored by physical hardware and massive switching costs, but it's trading at a premium valuation that demands flawless execution amid debt and margin pressures.
It's a high wire act. And I want to leave you with a final unmentioned thought to ponder.
Let's hear it.
Axon's current moat is built on logging and storing evidence after a crime happens.
Oh.
But if their new AI and drone tools fulfill the ultimate promise of predicting or preventing crime proactively, does the sheer volume of evidence data shrink?
Oh, how?
Could Axon's success in AI eventually cannibalize the very data moat that made them a $45 billion giant?
If the product is perfect, the raw material disappears. That is profound. Thank you for joining this 10-part deep dive. Keep exploring, keep questioning the narrative, and we'll see you next time.